Hi everyone, this is Peter Harris from Commercial Property Advisors and author of this book, Commercial Real Estate Investing for Dummies, and coach and mentor to many commercial investors across this nation. The subject and title of today's video is called Analyzing Commercial Real Estate Quickly and Easily. So let's get started. Commercial real estate is not as complex as you think it is. And in this video, I'm going to do my best to prove that to you. As a commercial real estate investor, you want to know three things about the deal you're analyzing. Number one is, how much money does it make? Number two, what is your return on investment? And number three, how does this investment compare to other investments? And what I'm going to do, I'm going to break down those three questions by going over these five key terms here. These five terms here are five key investment terms if you are going to invest in commercial real estate. These are your guiding principles of investment, and they are income and expenses, net operating income, or sometimes referred to as NOI, cash flow, cash on cash return, and capitalization rate, sometimes referred to as a cap rate. Any expert in commercial real estate will analyze, will gauge the performance of the properties based upon these five key things. So if you want to become an expert, you also need to know and understand and be aware of these five key terms. All right, the first one is income and expenses. Every commercial property that's income producing has income and it has expenses. Income is the lifeblood of any income producing commercial real estate. The income could be rents collected, it could be lease payments made by the tenants, it could be things as laundry income, late fees, and so forth. You kind of get the message there, what income is. Expenses are expenses needed, or expenses that the property incurs to operate the property. We call them operational expenses. They are insurance, taxes, utilities, repairs and maintenance, landscaping, property management fees, and the list goes on. Now, one thing that is not included in operational expenses is the mortgage expense. The mortgage expense is not included as an operational expense in a commercial property. It is a separate category. It is in the category of a debt expense. So we will not include it when we speak of income and expenses for commercial property. We will deal with the mortgage payments, the debt expense, and in number three here. Okay, we have a clear understanding of income and expense. Now, net operating income. Net operating income is one of the most important terms of these five. And the reason why is, as your net operating income goes up, not only does your cash flow goes up, but also the value of the property. And conversely, when the net operating income goes down, so does the cash flow, and so does the property value. Now, I'm going to write down for you the definition of net operating income. It's very simple. Basically, it is your income minus, excuse me there, all right? Net operating income equals income minus expenses. Income minus expenses. Now, let's say, for example, that you collected $4,000 in rents for 1 month and you have approximately $1,000 in expenses. So do the math. 4,000 minus 1,000 is $3,000. That $3,000 is what we call your net operating income. Now, what people get confused with is they get confused with net operating income and income, or gross income up here, or rental income. These are two different things. Your net operating income is your income after you subtract your expenses. Okay? That's the main difference. Again, this is probably the most important term out of these five for you to remember. Okay, next is cash flow. Cash flow is very simple as well. Cash flow is king in any income-producing commercial property. The definition of cash flow is also very simple. Cash flow is your NOI, your net operating income, minus your mortgage payments. Very simple. Cash flow equals your NOI minus your mortgage payments. All right? Next is cash on cash return. All right? This is one of my favorite terms here. And the reason why is I associate cash on cash return with the velocity of money, how fast my money is moving. For example, if you have $20,000 you're going to invest into a property as a down payment, the question you need to ask yourself is, how fast can I get back my $20,000? That's how fast your money is moving. Now, if you can invest your $20,000 and get it back within 12 months, 1 year, that's considered a 100% cash on cash return. If you can get the money returned back in 2 years, that's a 50% return, cash on cash return. 3 years, 33% cash on cash return. 4 years, 25% cash on cash return, and so on. I think you get the picture there. Cash on cash return, the equation there is your annual cash flow divided by your down payment. Okay? Cash on cash return is basically your return on investment. If you look at this equation, your annual cash flow divided by your down payment. In a couple minutes, I'm going to give you an example. I'm going to use all 5 of these in an example and break it down for you. There's nothing like learning by doing. Okay? That's cash on cash return. In commercial real estate, we can produce phenomenal cash on cash returns. If you were to take your $20,000 and you go to your local bank and deposit it there, and for 1 to 3 years with a CD, let's say it's a 1 to 3 year CD, and the banks will probably give you max 1%. That's about $200 a year. In commercial real estate, we could do 10, 20 times that, and most of the times tax-free. All right, something that a CD can't do for you. That's the benefit of commercial real estate. All right. Next is capitalization rate. Capitalization rate, or sometimes we call it the cap rate for short, is an industry-wide used term. Part of being an expert in commercial real estate is understanding what a cap rate is and how it pertains to each property and each neighborhood. Each neighborhood is stamped with a certain cap rate. Here is the equation for the cap rate. Cap rate is simple as well. It's your NOI divided by the sales price. Okay? NOI divided by the sales price is the cap rate. Another way of looking at cap rate from a layman's point of view is if you were to pay all cash for your investment, and what would be the return on that investment? For example, you saw a $500,000 strip center down the street, you wanted to buy it, you wrote a check for $500,000, you bought it. That means there's no mortgage involved. How much, what is the return on that $500,000 you spent? That's what a cap rate is. Now, cap rate can be used in many different ways. That's why I really want you to research and really understand cap rate. And I'm going to do a quick example for you too. But a cap rate, a high cap rate will be in a high cap rate property will probably be in a neighborhood that's not as good, maybe a low to moderate income neighborhood. So the higher the cap rate, the higher the risk, the higher the potential return, but also lower the price. Okay, let me repeat that. The higher you go in the cap rate, the higher the risk, because you're in a not so good neighborhood, the higher the potential return, but the price is lower. All right. Now, conversely, when you have a very low cap rate, what happens is you're probably in a much better neighborhood, a wealthy neighborhood, and so the lower you go in the cap rate, the lower the risk, the lower the return, but higher the price. You got it? Okay. Now that you really understand or have a understanding what these 5 are, what I'm going to do next is I'm going to give you rules of engagement for these 5 terms. Okay, so here are rules of engagement for these guiding principles, for these 5 key terms that every commercial investor should be aware of. All right. Basically, do not make an offer. Do not come to a conclusion of how a commercial property performs until you understand and calculate each of these 5. All right. I'm going to give you right now some rules of engagement. For income and expenses, it's very simple. We need the income to be greater than the expenses. Okay? That's the rule there. On the net operating income, what we need here is we need your net operating income to be greater than your mortgage payments. Okay? That's the rule for that one. For your cash flow, very simple. We need your cash flow to be positive. Positive cash flow. Cash on cash return, very simple too. Cash on cash return must be greater than or equal to or greater than 10%. Okay? On your cap rate, I'll keep it simple as well. Cap rate should be greater than or equal to 8%. All right? So now you have guiding principles when you're analyzing a income producing piece of commercial real estate. You know how things should flow, and you should know what your guiding principles are. Okay, now what I want to do next is to make all this make sense for you. I want to do a quick example for you and implement all 5 of these key terms. Okay? Okay, now I'm going to do a quick example for you. I'm going to implement all 5 of these terms into a deal. I'm going to make 3 assumptions for simplicity's sake. And those assumptions are, on this property, the purchase price is $450,000. I'm going to put down 25%, which is $112,500. And my mortgage payments per year are going to be $20,000. Okay? So I'm making these three assumptions on this deal. Now I'm going to take this information and apply it here. Okay? So let's say, for example, you know that the purchase price is $450,000. You know that the down payment is going to be 25%. And you know you can do your calculations on the mortgage and find out what the payments are per year. Okay? Let's assume you have those 3 pieces of information. From there, we're going to do the rest. Okay? So on this property, the income is $48,000 per year. Okay? And the expenses are $12,000 per year. Okay? And this is the income expenses are information you get from the broker, you get from the seller, you can get on an income expense statement. So that's given. All right? So you don't assume anything here. This is hard information from a reliable source. All right. Now to calculate your net operating income on this deal, remember that your net operating income was your income minus expenses. So income minus expenses. So $48,000 minus $12,000 is $30 here. So I have my net operating income. Next is cash flow. Remember, cash flow is your net operating income minus your mortgage payments. Net operating income minus your mortgage payments. So $36,000 minus $20,000 is $16,000 a year. Okay, follow me so far? All right, next is your cash on cash return, the velocity of money, your return on investment. If you recall, your cash on cash return was your annual down payment, your annual cash flow divided by your down payment. So your annual cash flow of $16,000 divided by your down payment of $112,000, that's 14%. All right, so your cash on cash return is 14%. Your cap rate next. Your cap rate again is if you were to pay all cash for your investment, what would that return on investment be? cap rate, if you call, is your NOI divided by your sales price. So NOI divided by the sales price. Okay? So if I do 36,000 divided by 450,000, I get 8%. All right? Okay, so these 5 now we just discovered. Now, was that too difficult to do? I don't think it was. All right. Now, these 5 things, again, anyone that's considered an expert, when they analyze any property, they will go through all 5 of these things, and so should you. All right, so now that you have those, let's go out, let's practice, let's go get some deals done here. All right, so now if you want more resources like this, please go to our website, commercialpropertyadvisors.com, or simply subscribe to this YouTube channel. Okay, so that ends today's video on analyzing commercial real estate quickly and easily. I'll see you next time.